Welcome back to the What Does It Mean podcast. I'm Lindsey Bell, and I'm here with my co-host today, Chris Versace. And we've got lots to cover today, Chris. We're going to talk about inflation, which we get at the end of the week. We're going to talk about tariffs, of course, and what that means. Are there deals that are possible? And finally, we're going to talk about the state of the consumer, because all these things are kind of connected, right?
I would say they're connected, and all three of them are driving the market as we know it today. A lot's going to happen over the next week, Lindsey. I look forward to breaking it all down.
All right, well, we're going to take a quick little break here, and we'll be right back. Welcome back, everybody. Let's dig right into it, Chris. Inflation. We get PCE on Friday. It is the Fed's favorite rate of inflation. There are several other measures. Is this going to matter? What are you expecting at the end of the week?
Well, I don't mean to blow your hair back, Lindsey, but I could care less what the report has to say. So the simple reason, it's February data at this point. We are well past it. We already know that inflation is, at best sticky, more likely moving in the wrong direction. And, that's fine for the month of February. To me, what we saw on Monday of this week, let me get this right. I don't want to discombobulate myself. It's the S&P Flash March PMI data, snapshot on the manufacturing sector, the services sector, but underneath a lot of great commentary that, I certainly look at every month. I suspect you do too. And what did it show? Guess what? Input costs rising, output costs rising. So this is March. So it tells us that, it's going to get a little bit worse. And then on top of that, I think we might touch on this, but if you didn't see it, Lindsey, in the March consumer confidence report,
Yep.
12-month inflation expectations jumped to 6.2%. That's up from 5.8% in March. We know all we need to know about inflation. The Fed's, favorite metric, be damned.
Well, I think there's a couple things going on there too, right? Yes, definitely the consumer is anticipating higher prices because it's been top of mind. It's in all the headlines, and then you get the social media, news media spins on it, right? So it's definitely on top of the consumer's mind. But the question is for, service providers and manufacturers, are they pulling forward the anticipation of higher prices because of tariffs? Is that what we're seeing right now? Or is it really that raw material prices are going higher, labor costs are going higher, these types of things that are going to be sustainable? And I think what we heard from the Fed, from Fed Chair Powell last week in his conference post the March FOMC meeting, is we heard that, he brought back the word
Oh,
transitory, right?
stop it.
With
Stop
with
it.
regards to inflation. But in all fairness, if inflation is going to be driven by tariffs, it is something, a bit of noise when he's looking for the signal through the noise. It's a
Mhm,
little bit of
mhm.
noise because, once you put the tariff on, it's a one-time increase. You see that throughout the next 12 months show up. And then once you lap it, like this happened with washing machine prices in
Yep, yep.
2018, right? Prices jumped up immediately. Once you got a year into it, then it was, a muted impact. So I think it's something that, inflation is going to need to be watched, but to your point, does it matter? I don't think people are going to, the market's going to move in a significant way on Friday in reaction to inflation, because I think people expect, first of all, the PCE is going to be a little bit warmer than what we saw from CPI and PPI, which moderated slightly in the month of February. And there's just a significant uncertainty about where inflation goes from here. So I agree. I don't think it's going to be, it might not matter this month, but it's going to matter in the months ahead. What do you think?
That I agree with. But let me, one thing that stood out in the flash PMI data that I referenced was that one of the big input costs was, yes, raw material prices, but wages. So, Powell last week said, oh, the employment market's not a big source of inflation. We might beg to differ there, Mr. Fed Chair. And I think it's something that we're going to have to continue to watch. But, at the end of it, Lindsey, I think as we look forward over the next couple days, we'll have a much better sense about inflation and inflation pressures, depending on what happens with tariffs.
Yeah, and the consumer, I just want to tie off one point. The consumer is expecting one thing. They're definitely worried, but markets are expecting another thing. The other thing you can do is look at the bond market. And I recently called this out in one of my LinkedIn posts is if you look at the break even rates on the 10-year or the 5-year tips, which is a treasury inflation protected security, the expectations for inflation have actually come down since January. And this is like a daily data point, right? It's based off of bond markets. So it's going to be interesting to see which way inflation does break. And so it's really, and the answer really is to know what happens with tariffs, right?
I 100%. I mean, we saw a nice pop in the market on word that Trump's April reciprocal tariffs may not be as bad as feared, right? He's kind of softening his position. I have to wonder, is this, typical Trump, a lot of bluster, and then the size of his stick gets a little smaller as we get closer, and he winds up, yeah, it wasn't as much as, you feared, and it's still a win. Let me tell you why it's so great, blah, blah, blah. So I'm kind of wondering if we get, smaller scaled reciprocal tariffs, either in the number of items, the countries, or the size of the tariff. But I also think that because, you are seeing trade representatives from the European Union, India, make their way to Washington early next week, that I wouldn't put it past him to announce some type of trade deals and smaller tariffs. You know, it's a win for America, Lindsay.
Yeah, I mean, he came out of the gate, when he was inaugurated, like in at the beginning of February,
Mhm.
he was very hard line with tariffs with China, Mexico, and Canada. And I think now he's seen the reaction to the market. I know that he's saying in Trump 2.0, the market doesn't matter,
Right,
right? And
right.
you're gonna take some short-term pain for longer term gain. But I also think it sent a signal to other trade partners that if we're willing to be this hard on, our allies and our neighbors, at least from a Canada, Mexico perspective, we're serious about figuring out this trade thing that we've got going on, and so I think that that gives them reason to come and have these conversations, and I do think that Trump we talked with Arthur Laffer
Mhm.
not that many weeks ago, and he made the point of, at that point in time, we were, like, in the weeds of it, it did not feel good, right? And the expectation was, like, the world is gonna end because these tariffs are higher, they're broader, and they're happening more swiftly than we've ever
Right.
experienced, except maybe during the Great Depression, right? Or the 30s, I should say. And so I think that like that expectation has subsided a little bit with some of these news headlines that Trump could be a little easier, even from the horse's mouth. There might be some deals to be made with Europe
Mhm,
and some of these
mhm.
other reciprocal in the reciprocal trade conversations. So I think that the market is digesting this a little better. That doesn't mean things can't go a wire next week. April 2nd's the big
Oh,
day, right?
no, I mean, I always go back to the art of the deal, and when you kind of think about that, it's clear that, he likes being bold, assertive, unpredictable because it helps, it keeps his opponents off balance and it gives him the upper hand. So am I surprised that he has sent mixed messages over the last couple days? Not at all. And I think I would like to think, right, that he has a very good idea of what he's doing and he's playing these games right up until the last minute, the brink, and then we'll see what happens. So, like I said, I wouldn't be surprised if we get some type of hybrid, quote unquote Trump win, as he likes to say. Um, if we get that, then I think that the market has room to move further higher, continue to rebound. But then we do have some stiff resistance. The 50-day moving average, the 100-day moving average of the S&P 500 are pretty tight, and that could be a nice wall of resistance that we need another catalyst to get over. But Lindsay, if he doesn't deliver that, then what?
Yeah, if he doesn't deliver that, then it's we're going south again,
It,
right? I mean, this whole market, this whole economy really does hinge on tariffs at this point in time.
yeah.
You know me, I'm a glass half full type of gal, and I'm trying to always be optimistic and look for the positives in every data point, right?
Mhm, mhm.
Yes. And so,
I'm sipping from that half glass full right now.
so I see a lot of positives in the fundamentals. I see a stable economy right now, but if we get tariffs that are deeper and broader than we had anticipated, that's gonna have a negative
I
impact, you
agree.
know?
I
And so it's really hard to plan for the future, and I think that's why you've seen the volatility in the markets.
Well, think of what you just said. Very hard to plan for the future, right? Where I know we're going to talk about the consumer in a few minutes. We know that business uncertainty is at or near record levels. So if Trump doesn't deliver something positive, right? Lower tariffs, trade deals, if he doesn't deliver that and we go forward with tariffs, that uncertainty is going to go, even higher. And then I have to think, Lindsay, and I've been talking about this for a little bit. I think we talked about it last week, but June quarter guidance. How could it possibly be as strong as the market expects if we're rolling in with more tariffs? I just don't see it.
Yeah, and I think, we have talked about how those numbers have come down a little bit, so there's a little bit of conservatism being baked in, but it's not expecting anything dramatic. And what I will say, the only thing I will say about that's positive here about tariffs is that it has created this re-rating in the market. So the market multiple is at about 20 times now,
Yeah.
where it was getting 22, 23, getting up to dot-com bubble levels, okay? Before all this tariff, back and forth started. So that's a multiple that's more in line with, say, the 10-year average of 19 times,
Hmm.
much lower.
Hmm.
It's still much higher than the long-term average of about 16 times. So you've got the valuation being brought in and coming back to reality, which has been good, and it's, a lot of gas has been taken out of the tank of some of these tech stocks. But the second thing I would say about tariffs is monetary policy. I feel like this thought came to me last week when I was thinking about the Fed, is that has monetary policy been put into perspective? Has it been put into perspective because of tariffs? Because monetary policy has juiced the markets, printer go burr,
Yeah, yeah,
right?
yeah, yeah.
The whole meme. And so people have turned to monetary policy to be a support for the market when it's really supposed to be a support for the economy. It's supposed to ensure stable prices and full
Hmm. Hmm.
employment, right? And so it's almost like I think the market's finally remembering that and starting to get the message that higher for longer isn't such a bad thing if economic growth is continuing.
Well, yeah, exactly. Why is it higher for longer is the question you have to ask. It's because the economy doesn't need the paddles of support by lower interest rates. That's a good thing. But what did you make, Lindsay, of Atlanta Fed President Raphael Bostic coming out and saying, "Hey, folks, I only see one rate cut now in 2025," and we're just coming off the Fed's updated set of projections last week that said two.
Yeah, I mean, look, let's be real. It's predicting where interest rates are going to be on December 31st is it's hard in any year, but
Hmm.
especially in a year like this with the uncertainty of tariffs and what it means for inflation and employment and all those things. And so I think it's hard to say. You know me, I've been in the camp like you that there'll be less rate cuts
That's right.
rather than more rate cuts for this year. And I still expect that primarily because inflation has remained above the 2% target across all metrics. And so to me, I'm not surprised to hear that. And I honestly, again, I think that the market is not, the market's at 2 to 3 cuts this year, and that can change quickly too. Is the Fed's expectations, the market's expectations, this all can change very quickly.
It's
Doesn't mean it's gonna be smooth and easy, but it can.
Um, I suspect less than 2. I will timestamp that to today's podcast. The wild card, just to bring it back to what we were talking about before, Lindsay, it's gonna be tariffs. If we don't get those tariffs, then maybe we do see some cuts. If we get tariffs, I just don't see how it's gonna happen.
Well, let's tariffs get that's a great segue again into our final topic is the consumer, okay? Tariffs have been weighing heavily. We started talking about it on the mind of the consumer, right? And what we've seen
Mhm.
in these consumer sentiment. We got the conference board this week. At the end of the week, we get Michigan, and what we've seen is tariffs weighing heavily on the minds of consumers. It's driving a significant amount of pessimism in these surveys, and it's also leading to higher expectations for inflation down the road. How do you see the state of the consumer? What's your vibe, your feel of the consumer?
Well, I'm going to date myself a little bit. Um, did you ever see Rocky 3, Lindsay?
Probably not the third one, no.
Probably not the third one. So there's a scene in there where Mr. T as Clubber Lang is asked for his prediction when he has a rematch with Rocky Balboa, right? Every kid my age, like, edge of your seat, seeing this massive battle between these two on the screen. And Mr. T goes, my prediction is pain. So I'm a little concerned about the consumer because, we're coming off and we've talked about, some recent waves of consumer activity being softer, the number of retailers that have issued softer than expected guidance. We take a look at some of the survey data. Consumers are not really feeling all that good. They're concerned about inflation. They're concerned about a recession. We tend to potentially have a mix of a self-fulfilling prophecy, right? They're seeing
Mhm.
layoffs, right? So they get worried. When that happens, they tend to retrench. But that's all kind of touchy-feely, squishy kind of things, right? What stands out to me then is something I read this morning in getting prepared for our conversation. And this comes from Synchrony Financial. And you're going to say, some folks will be listening, being like, who is Synchrony? So they have issued about 100 million credit card accounts across various retailers and merchants. So I would say that they have a pretty good pulse on what is happening in terms of consumer spending. So the chief credit officer, Max Axler, who, what parent? Max Axler. Oh my goodness. I feel sorry for Max. Anyway, he said that purchase volumes have gone down across the industry as consumers across all income groups become more thoughtful about spending. So that to me says that consumers are tightening their belt. They are retrenching in their spending. Maybe good for Costco if they're concerned about inflation, BJ's, something like that, Amazon. But by and large, not good for the economy.
Yeah, you know what? It's funny though. What I would say to that is it's like there's all this contrasting data points out there across the economy. And like for that, for example, you heard Brian Moynihan just, I think it was last week,
Mhm,
talk about how
mhm.
the economy wasn't, I don't know the exact quote, I don't have it in front of me, but it's something about the economy isn't as bad as people think and the consumer is hanging on there. And again, I think that there's differences between income groups,
Yes.
for certain, no doubt about it. I look at the retail sales number, it was up 3.1% in February, which is, by the way, below its historical average of 4.6%. But what I would say is you don't want that number above the historical average because the only times that it's been above the historical average, not the only times, but the majority of the time that it has been in like exuberant periods.
Right.
So leading into the financial crisis, leading into the dot-com bubble. And then you also see it above there like in 2021 to 2023 when it was a massive bounce back after a massive decline in retail spending because of pandemic lockdowns. So what we've seen in the past is that consumer sentiment has at times been correlated with consumer spending, but what's more correlated and more accurate is wage growth to
Oh
consumer
yeah. Yeah,
spending.
yeah.
And right now, wage growth remains solid. We're seeing actual real wage growth. So wage growth above inflation, which is why you called out earlier the
Yeah.
potential for wage growth to impact inflation. So I think that it's gonna be like we're in wait and see mode. The consumer is certainly nervous. They're certainly making choices. But companies are still hiring, wages are still rising, job openings still exist.
Mhm.
Granted, I would say my rebuttal to that would also be because I worry about the consumer too, is that the hiring rate is really very low. It's at levels that's usually equivalent to much higher unemployment rates. Wage growth, you're seeing as in an aggregate number. When you look though at the middle, that that's been very stagnant for middle income earners. And the low end has been seeing the raises, but it's not helping them with cost of living.
Well,
So
did Did you
So there's again, it's mixed data, right?
on
But go ahead.
sorry, on that point though about the lower end and even the middle tier consumer, there's some data out recently that, and I always am shocked to see these figures, but it's like 64% of consumers live paycheck to paycheck. And I think about the inflation concerns. I think about, like what we saw with the um, February Challenger job cuts report, popping higher. I think it's understandable that folks are gonna just take a more conservative approach to their spending because of so much uncertainty.
No, I think that's a fair point, and I think it's why you're seeing inflation's expectations spike so dramatically over the last couple months from the consumer and these consumer surveys. And this consumer is very like price sensitive at this point in time. So I think companies have something. If these tariffs do go through, companies have a choice. We've historically seen these price increases passed on to the consumer. It happened during the pandemic. It
Hmm.
happened
Hmm.
over many points in time, but that doesn't have to be the answer. It could be that, the companies themselves eat some of that price increase. They push it on their suppliers, things like that. Of course, I think it's some degree of it is gonna be passed on to the consumer, but we shall see.
I love it when you set me up, Lindsay, because that leads me to say that one of the most important line items when companies report and give their guidance, yeah, we'll be concerned about the top line, the bottom line, margins. Margins are going to be key as they grapple with rising prices, rising inputs, and what they can do on pricing. So that's what I'll be watching. I was going to save it for the wrap up, but you just teed me up.
Well, I think that's gonna wrap up this section. That was a really good, way to tie the whole conversation up between inflation, tariffs, and the consumer. We'll leave it there. We're gonna take a quick little break, and we will be right back. Welcome back, everybody. Chris, we had a really robust conversation there about all the important things that are driving markets today. What stood out to you? Did
Well,
I did I leave any gems out there for you?
Well, you know what? Everything you say is so well thought out, and it just falls into place that it's so hard for me to pick out any one, Lindsay. I can't handle that kind of pressure. But it had me thinking though, or the course of the conversation about something that Art Laffer said when we spoke with him a couple of weeks back. And he goes, if you remember this, he goes, "What if it all goes right? Everybody is so worried about what could go wrong." And that really sat with me for the last couple of weeks. And I think about our conversation about, tariffs being potentially smaller, maybe some trade deals. Oh, yeah, that would be good. But if we get that, then maybe the inflation expectations have to come down. Maybe consumers start feeling a little better. Perhaps if it all goes right, the economy could pick up, the market could pick up, and we can have a better second half of the year.
Yeah, and I think part of that is being priced into the market now. What we've seen over the last several trading days or maybe almost a week now, the market has definitely calmed down a little bit. And so I think that, with the headlines that there might be some deals with Europe or whatnot, some of it's being priced in, but that not all of it. Like I said, the multiples come down
Yep.
significantly. If margin expansion continues, like you said, let's watch margin expansion. And if the consumer's optimism picks up, we're living in a whole different world, aren't we?
100%, Lindsay.
All right. Well, there's lots to watch going forward. That was a really great conversation. We talked a lot. We covered a lot of different things, moving markets right now. But that'll be a wrap. You can find Chris over at the Street Pro Portfolio, and you can find me at clearnomics.com or both of us on LinkedIn. So thanks for listening, and we will catch you next week.